Welcome to another session of Learning with Simran. So today we'll be looking at Introduction to Accounting. Accounting is one subject which I'm a great fan of. I love accounting. So today I'll be taking you through with its introduction. So here you'll be coming across accounting theories, concept, principles, and there's many more to learn from accounting. All right, so let's begin. The first basic question, what is accounting? So accounting is a process of identifying, recording, communicating financial information of a business so people can make informed decision. So the way in which I remember it, accounting is a process of recording, reporting, interpreting financial information for the purpose of helping individuals make informed business decisions. So you would record a piece of information, you would report it, you would interpret it, and then you try to communicate that information to interested party for the purpose of decision making process. So the purpose of helping in decision making rather. So first you would be identifying it, you would spot the transactions and the events that affect the business financially. Next, you start recording it. So here you try to measure and log every transaction accurately and in order. Next off, you try to communicate. Remember, the main reason we are doing accounting is so that we would be able to communicate the information to the respective interested stakeholders who would be interested in this accounting information because that is going to help them in informed decision making. So that's basically accounting. So there's four blocks that we'll be exploring. We'll be looking at the foundations of it, the recording process, the financial statements being one of the major ones, as well as the concepts and principles. We might be looking at this earlier in the first few stages. First of all, the foundation of accounting, we will be seeing accounting equation, as well as learning about the double entry concept. So let's see. So the accounting equation basically states that all your assets of the business should be equal to your liabilities plus your owner's equity. So this is A is equals to L plus P. Everything you own should be equal to everything you owe. That's how I remember it. So whatever you own in a business should be equivalent to whatever you owe in a business. So that's asset. This would be the equity section. So A is equals to L plus P. Assets is basically whatever is owned by the business, whatever the owner would keep. So the business owns cash, stock, equipment, as well as the funds in it, as well as buildings, vehicles, you name it. So there's so many different types of asset which the businesses they keep. Liabilities, on the other hand, is what the business owes to other parties. So this is everything which is owed. This can be in those form of big loans which the business has taken, mortgage, unpaid bills, and everything which is in debt. Owner's equity, this is referring to the proprietorship section or the equity section. So this is the owner's stake. How much the owner has invested. So that would be in the form of capital. So the owner's input would be regarded as capital, and what's left for the owner after debts are paid. So the equity section or the proprietorship section, some call it, or the owner's equity rather, this refers to everything related with the owner, the proprietor. Right. So for every transaction keeps this balance or keeps this equation in balance. So this is the heart of double entry accounting. So you must be noticing there's a lot of mention about double entry concept. Double entry concept basically states that for every transaction there has to be a debit and a corresponding credit entry. So if there's things which has been debited in the asset, there has to be corresponding credit entries coming from liabilities and equity sections as well. So that's what the double entry concept focuses on. Now let's see the accounting cycle. Every transaction travels the same path from a receipt on the counter to the final reports. So this is the accounting cycle. You would need to have source documents. Source documents, as per the definition, these are evidence that a transaction has taken place. So every time a transaction would happen, there has to be a relevant source document relating to it. If not, there would be no evidence to state that that transaction has happened. So different types of source documents exist. You have receipts, you have invoices, you have checkbooks, we have credit notes, and there's so many others. So those are evidence that the transaction has happened. So once the source document is the evidence showing that a transaction has taken place, then you start recording it in journals. Once you have done your journal posting, then you do ledger. So you'd be sorting these accounts out. You'll be showing which account is affected. So ledger accounts, this is the T accounts. Once you have appropriately prepared the ledger accounts, then you start doing the trial balance portion of it. After trial balance, then you have the financial statements. So these financial statements would be the profit and loss, inequity, financial position, financial performance, etc. Right, so that's basically the accounting cycle. If you're able to understand from the very first beginning to the end, it'd be great to go with accounting. Honestly, this is the hardest part, which a lot of students they get lost in. All right, so we have covered off the accounting cycle. Should you require more information or require us to conduct your tutorial sessions, please do get in touch with Premium Tutoring. We'll be gladly happy or rather glad to take you through with our accounting lessons. Trust me, you'd not regret it. Thank you.